This video is for educational purposes only. It should not be considered investment, legal, or tax advice. It is not an offer to buy or sell any security. Past performance does not indicate future results. Investing is risky.
The day is March 1st, 2013. You have the option to invest in either asset A or asset B. Asset A has a dividend yield over 10.4%, and it has exposure to the NASDAQ 100, which you know for sure is going to have a fantastic decade. Asset B, on the other hand, has exposure to some high dividend yielding stocks that are in very boring industries like utilities and energy, and very little exposure to technology. This asset also has a much lower dividend yield at just 2.5%. Now, which of these assets would you choose to invest in? You would obviously choose to invest in asset A. In fact, at a 10.4% dividend yield, you may actually be able to retire early and just simply spend the income that asset A would produce. Let's say that you have $50,000 in annual spending, and whatever your actual number is, you can feel free to put that in here. So all you need to do in order to determine what you need is divide that by whatever percentage dividend or sustainable spending rate you want to use. So let's say that 10.4% is the dividend yield you're getting in asset A, so you conclude, well, as long as this continues to pay these dividends, I'm going to be just fine, and I can spend $50,000, and all I need to save in order to do that is $50,000 divided by 10.4%, which is also 0.104, approximately $480,000. Now let's say you're looking at asset B. So this is asset A. Asset B with a 2% dividend yield. In this asset, you're going to need a lot more money. So $50,000 divided by, instead of 10.4%, we're going to do 2.5. So 0.025. And for this particular asset, you're going to need to save $2 million. Which of these would you prefer? Well, obviously, you're going to prefer asset A. The higher dividend yield allows you to save less money and therefore retire even earlier. This logic was described in a very popular YouTube video that I saw several months ago posted by Dividend Bull. What would actually happen between investment A and investment B if we look at actual data from 2013 through 2023? To find out, I set up a little experiment. So we said on March 1st, 2013, we invested $480,000 in two different assets, asset A and asset B, one with the 10.4% dividend yield and one with 2.5%. At that yield, asset A should generate about $50,000 in year number one, which is what we're assuming that we're going to need to spend. We're also going to assume that that spending is going to increase each and every year with inflation. Asset B, on the other hand, is only going to generate $12,000, so we're going to need to come up with the rest of our spending by selling stocks. Also in this example, we assume that if there's any extra dividends that are generated that are not spent by this $50,000 spending, we will reinvest those dividends. So what would happen if you set up both of these portfolios simultaneously? This chart is an actual simulation from Portfolio Visualizer showing these two assets. You can see that both of them start out at $480,000. However, it's very clear that this red line does significantly better. By the end of the 10-year period, you had $400,000 left. Meanwhile, the blue line ends up at less than $200,000. So which of these two lines represents each portfolio? We have asset A was the 10.4% dividend yield, and asset B was the 2.5% yield. Which do you think is which? Well, as it turns out, this is asset B, the high dividend yield asset. Blue line is asset A. But wait a minute, how did this happen? We had an asset that was producing $50,000 in annual dividend payments at the start of our investment. Why did that not support an ongoing lifestyle of $50,000? And how did asset B hold up so much better despite having a far lower dividend? And Probably the question you're wondering the most, which of these assets is what? We'll talk about that here in just a second, but first I want to walk through a couple of other charts. And understanding these charts is critical to avoiding a massive mistake that most dividend investors make. So here we have some data from my favorite data source, Portfolio 123, and this shows asset A going back to 2014. We collected a huge dividend that started off the period at a dividend yield of 10.4%. But this is really the culprit. At the start of this period, this particular asset paid a dividend per share of $2.65. At the end of the period, almost 10 years later, that dividend was down over 22%. On the other hand, asset B, we see a very different story. The annual dividend yield per share started at under $1, right? So this was the $12,000 in annual dividend income, but over the course of 10 years, this increased by over 150% to $2.64 per share. And we also see that this increasing annual dividend also put upward pressure on the price of this particular asset, which also increased by about 150% from around $30 back here in 2014 to over $70 in 2023. So what is investment A and what is investment B? Investment A is the wildly popular and widely misunderstood QYLD, and investment B is the also wildly popular Dividend Growth ETF, SCHD. Now, let me make one thing clear. I am not hating on QYLD. The problem with QYLD is not necessarily that it's a bad investment, but it is very poorly understood, and people think what it is actually different than what it actually is. QYLD is not a license for you to spend 10% or 11% or 12% of your portfolio each and every year. That is not going to result in a successful retirement. Contrary to a lot of popular videos out there, this is not a retirement cheat code. If you follow this strategy, I'm very afraid you're going to run out of money in retirement. And the reason is that covered calls are not dividends. When you or an ETF writes a covered call, it is using an option, and that option premium is the income that you're seeing. While that may not sound like that big of a deal, in reality it is. Generally, a dividend that's paid by a company like Procter & Gamble or Johnson & Johnson is generally going to increase over time as the profitability of that company increases. A covered call, on the other hand, does not do that. To illustrate, let's say we've got on this axis the amount of profits you're making on a particular investment. So we'll say this line represents a profit of $0. So anything above this line is a gain, and anything below this line is a loss. And on this line, let's say we have the price of a particular stock. So let's say you make an investment in this particular stock at $100 per share. And let's say you bought 10 shares, so your initial investment was $1,000. So if the price of the stock, say in 1 month, were to drop to $90, that means you're going to have a loss of $10 per share, or about $100. So you're at a $100 loss. And as the stock price would continue to fall, your loss would get bigger and bigger. Conversely, if the stock price increases, your gain is also going to increase. Now let's say at the same time you bought this particular asset, you also wrote a covered call. Someone else paid you a $10 premium, and we'll say the strike price was at $100, and all the strike price means is at the end of the period, if the stock price is above whatever the strike is, in this case 100, then the other party, the one that paid you the premium, is going to get the right to buy those shares from you at $100. So if the stock price were to, let's say, remain at $100 per share, all of a sudden now you have done a very smart thing. Is you got your $10 premium, the stock stayed at $100 per share, so you basically just collected $10 from this other party. So even though the stock didn't go up, you still made a profit. And in fact, you would still make a profit even if the price of the stock were to decline down to 90. So you would still own the stock, but but you would have made a $10 premium, so this particular loss would not actually hurt you. If the stock price were to fall below 90, you're still better off than if you would have held it without the call option, because now you're $10 better off. So your loss isn't as severe, even though the price is going down. If the stock were to instead go to, let's say, $110, your profit would still be only $10. You bought the stock at $100, you collected the $10 stock premium, and then the other party would exercise the option. So basically their $10 premium went to get the stock price at a $10 lower price. So they made a $0 profit. You still made a $10 profit. However, if the stock price were to go to, say, $150, you are now capped at this particular profit level, and you would have been much better off to just hold the underlying stock. So this is the trade-off of a covered call option. Compared with holding the stock, you would do better if the market were to go down or remain flattish. You do a lot worse, however, if the stock price increases significantly. Basically, you are selling, the option premium is like selling the upside of a particular investment. Basically, if you believe the market is going to stay relatively flat in this range between, say, $90 and $100, then you would benefit significantly from writing this covered call. If, however, the market were to absolutely tank, you're going to do a little bit better than the person who just held on to the same underlying stock, but you still have unlimited downside. If the stock price goes to zero, you are going to be wiped out, less your $10 premium. If, on the other hand, you think the market is long-term heading for gains, you would not want to be in a covered call position because the upside is being sold. So you're going to miss out on a lot of these gains if you were to continue to write covered calls. The other thing to remember about covered calls is that they are usually written as a certain percentage of whatever the underlying price is. So if you have a stock go from $100 to $50, and now you try to write a covered call on it again, you're not going to get the same premium that you got at $100 because the stock price is now lower. The only way you're going to get that same premium is if the buyer of that particular option is thinking that the future volatility could be a lot higher, then they might be willing to pay more. So higher volatility or higher expected future volatility will increase the amount of premium that you would get from a call option. Conversely, lower expected future volatility will reduce that premium. So that means if you own a covered call ETF, the income that you're going to get will fluctuate based on the price of the underlying and the amount of expected volatility that you're going to have. So as a result, when we look back at the actual portfolio in Portfolio Visualizer, this being QYLD, asset B, the red bars being SCHD, you can see that even though the income started at $50,000, it steadily kind of decreased over time. So you go all the way out here to 2022, and the income is now only $29,000. And the reason that happened is twofold. The first reason is that the dividend income did decrease per share. The other thing is you were having to reduce the amount of shares you owned. You were having to sell those shares in order to make up the difference between what the income that was paid. So in this case, the income paid was $41,000. You had to sell $9,000 worth of QYLD in order to meet your $50,000 expenses, which, by the way, were also increasing each and every year with inflation. So your spending was increasing, your income was decreasing, and as a result, you basically were getting very close to running out of money after just 10 years. Meanwhile, if you look at SCHD, you see that these income bars were overall flat over time. So even though the dividend per share was increasing each and every year, you were also having to sell shares in order to make up the gap between the income produced and what you actually needed to take out of the portfolio. However, that gap is significantly lower here at the end when SCHD was producing just over half of what QYLD was, whereas at the very beginning, it was producing basically 20% of what QYLD was. So if we continue this line out far enough, eventually SCHD will be producing more income than QYLD. And that's particularly true in this person's scenario because they only have about $200,000 left and they're still spending basically $50,000 plus whatever the cumulative inflation would be over this time period. So this portfolio is probably going to run out in a couple of years. But obviously, I mean, this is not an endorsement to spend 12% or 10% in SCHD either. I mean, even though you had a lot more than you did with QYLD, you still see that the portfolio value is down about $100,000. So eventually, I think the same thing is going to happen with SCHD. Many decades of wisdom and financial research suggest that about 4% of your portfolio is what you should spend. Anything more than that puts you at great risk of running out of retirement assets if the market is not good to you. Now, spending only the dividend income generated by a portfolio will greatly reduce that risk, but only if those dividends are sustainable and are able to increase at least as fast as the pace of inflation. If one of those two things is not there, you're going to end up with a dangerous situation in retirement. So it's very important to find assets that you're able to rely on the dividend income not only today, but also for many years to come. And I'm afraid QYLD or any other investment that promises a 10+% distribution rate is not going to be sustainable over time. If it were, then we're basically saying we're throwing out, decades worth of wisdom from some of the greatest investment minds. Do you really think that this simple covered call strategy is something that nobody else has thought of before? I don't think so. So this idea that you can simply save a lot less and retire a lot earlier just spending the income generated by QYLD is a very dangerous idea and one that I would strongly caution you to adopt. Do your homework, do your due diligence, make sure you understand how QYLD works before you invest in it, and certainly before you rely on it to generate retirement income for you. It's very likely that the income generated is going to be stagnant, if not decreasing, over time, so just be very careful with that. That being said, I'm not saying QYLD is a bad investment. It's a good investment if you expect the market to remain range-bound or if you expect future volatility to be lower than what premium buyers are willing to pay for today. For those of you who are members on YouTube or supporting me on Patreon, I just posted a video looking at what the current value of the S&P 500 should be based on historical data going back to 1960. In that video, we'll look at, is the market as overpriced as everyone seems to think it is? Or have lower interest rates increased the fair value to the point where buying stocks still makes sense? We'll take a look at the data behind that video in more detail, and I'll also give you my conclusion of where I think valuations most likely stand as of today, which is May 12th, 2023. So if you're interested in that video, be sure to check that out. If you're not already a member or a Patreon supporter, you can sign up for that. I'll put a link in the description below. It's just $5 a month, and that goes to helping me make these videos, buy all these subscriptions, buy all the camera gear, audio gear, just to kind of keep this channel running. Thank you so much to everyone for your support. Thanks for watching, and I will see you in the next video.